Today's modern corporate structures operate not as single businesses, but as vast, complex, and highly interconnected webs of legally separate entities. A parent's standalone statement of financial position captures ownership through a single line item, investment in subsidiary. This acts as a financial black box. When opened, it reveals a complex reality of individual assets heavily offset by liabilities. Because these operational details are hidden in the standalone statement, an investor reviewing only the parent's records will underestimate the total resources and actual debt. Relying on these standalone legal statements provides an incomplete picture of a group's actual financial leverage. Accounting standards resolve this problem using a governing concept called substance over legal form. While a parent and subsidiary possess separate legal identities, they function economically as a single unit. Consolidation requires replacing the parent's static investment account with the subsidiary's underlying line-by-line financials. This reporting requires a structural engineering process, combining specific assets, accurately allocating equity, and eliminating internal mirrors. This diagram illustrates the sequence of the 5-step pro forma consolidation process. The process begins with Step 1, identifying the group structure and determining if consolidation is required. This organizational chart shows a parent company controlling 2 subsidiaries. In financial reporting, a parent is presumed to have control when it owns more than 50% of a subsidiary's ordinary voting shares. When a parent owns less than 100%, the remaining equity belongs to external outside shareholders, the non-controlling interest, or NCI. If a parent company purchases 80% of a subsidiary's shares, 20% mathematically defaults to the non-controlling interest. While these outside investors do not dictate corporate operations, they hold a legally binding claim on a specific portion of the subsidiary's net assets. Step 2 involves analyzing the subsidiary's net assets. In group accounting, equity is strictly bound by time. The date of acquisition is the dividing line. Pre-acquisition reserves are the retained earnings existing before the parent obtained control. They are considered purchased equity, not group profit, because the parent didn't earn them. Post-acquisition reserves represent profits generated after control was obtained. These are the only profits actively split between the group's retained earnings and the non-controlling interest based on their ownership percentages. Accidentally mixing pre- and post-acquisition reserves will mathematically overstate the parent company's operational profit. Step 3 calculates goodwill. In reality, parent companies rarely pay exactly what a subsidiary's paper assets are actually worth. A parent may pay a premium for unquantifiable advantages like reputation, customer loyalty, or a skilled workforce. This excess value is positive goodwill. To calculate this, the consideration paid by the parent is added to the non-controlling interest and compared against the fair value of identifiable net assets. When the cost outweighs the assets, the difference is recorded as positive goodwill, an intangible asset. In the inverse scenario, the fair value of net assets acquired is greater than the consideration paid. This creates negative goodwill, or a bargain purchase. Common in distressed sales, accountants must reassess measurements for errors before recognizing this difference as a gain. Goodwill quantifies the subjective premium or discount a parent accepted to achieve control. Step 4 determines the reporting date value of the non-controlling interest. Because ordinary share equity is a residual interest, priority claims must be settled first. Subsidiary cumulative preference shares held by external parties often complicate this calculation. Preference shareholders hold a priority claim over ordinary shareholders regarding dividends and net asset allocation. Before allocating profit to ordinary shareholders or the NCI, outstanding preference dividends must be deducted, reducing the pool of available ordinary profit. Only after this priority deduction is cleared can the standard proportionate method be applied. The final NCI value is found by multiplying the NCI percentage by the adjusted subsidiary net assets at the reporting date. Failing to isolate these priority claims allocates wealth to ordinary shareholders that they do not actually own. The final phase is eliminations. A corporate group cannot owe money to itself. When a parent holds debentures issued by its subsidiary, The parent records interest income, while the subsidiary records an identical interest expense. During consolidation, this internal income and expense must cancel each other out. However, if subsidiary debentures are held by external investors, they represent a genuine group liability and must remain on the consolidated statement. Systematic elimination prevents the double counting of revenue and ensures the final statement strictly displays obligations owed to the outside world. We can now return to the standalone statement of financial position and that opaque investment in subsidiary line. In the final assembly, the parent's investment account is removed. The subsidiary's actual assets and external liabilities are merged line by line with the parent's figures. The calculated goodwill is added to the intangible assets section to account for the premium paid for control. Finally, the non-controlling interest is recorded in the equity section, representing the external shareholder's distinct claim. Through precise combination, temporal allocation, and internal elimination, we have constructed a document that reflects the true resources and obligations of the corporate group. While legal boundaries dictate a single company's liability, in financial reporting, it is economic control point that dictates reality.